In our previous session, we discussed Introduction to Financial Planning. Today, we are going to explore a new topic termed as Forecasting Financial Statements. Imagine you are tasked with preparing next year's financial plan for a company. You need to forecast the income statement and, of course, balance sheet to project the overall profitability and the financial health. How would you determine future revenues, expenses, and asset requirements? Why is it crucial to accurately forecast these statements for effective business decision making and planning? At the end of this topic, you will be able to explain the methods of forecasting income statements. You will be able to understand the forecasting of balance sheet. Financial forecasting is the process of predicting an organization's future financial performance by analyzing historical data, market trends, and economic conditions. It involves estimating revenues, expenses, and cash flows over a specific period to guide decision making and strategic planning. By providing insights into potential opportunities and risks, financial forecasting helps businesses allocate resources effectively, prepare for uncertainties, and align their goals with the market realities. For example, a company may forecast sales growth to determine production capacity or plan investments. Accurate financial forecasting is essential for maintaining stability, achieving long-term objectives, and ensuring sustainable growth in a competitive environment. Forecasting income statement involves estimating future financial performance using three primary methods. Number one, percentage of sales method. It assumes costs and revenues are proportional to sales, making it deal for stable, predictable businesses. Number two, budgeted expense method. Focuses on forecasting individual expenses and revenues, providing detailed insights but requiring more data and effort. Number three, combination method merges the first two approaches to balance simplicity and detail, allowing flexibility for complex businesses. These methods help businesses project profitability, align budgets, and plan strategies effectively. For instance, the percentage of the sales method is useful for rapid estimates, while the budgeted expense method is better for accuracy when detailed financial data is available. The percentage of the sales method assumes that the historical relationship between sales and various cost items will continue in the future. It uses the ratio of each cost item, for example, cost of goods sold, operating expenses, to the sales value as a basis for projecting future cost. This method is straightforward and effective for businesses with stable cost patterns relative to sales. For example, if past data shows that marketing costs consistently represent 10% of the sales, this percentage is applied to forecast future expenses based on projected sales. However, it assumes linearity and may not account for variable cost or unexpected changes. The income statements of 2021 and 2022 for a firm are given below. The sales forecast for 2023 is Rs 700 crores. Forecasting financial statements. The projected income statement for the year 2023. The budgeted expense method is a more flexible approach compared to the percentage of sales method, as it projects each cost item separately rather than assuming all cost will follow the same proportion to sales. This method involves analyzing each cost element individually, considering factors like nature, market trends, and future development related to each expense. While more accurate, it is also more time consuming and requires greater effort to collect detailed data and forecast for every cost component. It is ideal for businesses that need a more precise and adaptable forecasting approach. The combination method merges the simplicity of the percentage of sales method with the precision of the budgeted expense method. While the percentage of sales method is straightforward, it assumes all the costs behave proportionally to sales, which may not be accurate for all cost elements. On the other hand, the budgeted expense method offers greater accuracy but is time consuming and unnecessary for the costs that follow predictable patterns. The combination method applies the percentage of sales approach for predictable cost and uses the budgeted expense method for variable or complex cost, ensuring a balanced and efficient forecasting process. The combination method is a practical approach that integrates the strengths of the percentage of sales and budgeted expense methods. It involves forecasting some cost elements using the percentage of sales method, suitable for costs that maintain a stable relationship with the sales. Simultaneously, it applies explicit budgeting to forecast variable or unpredictable costs that require detailed analysis. This balanced approach ensures accuracy without overcomplicating the forecasting process, making it efficient and adaptable. By combining both methods, businesses can create more reliable and flexible financial forecasts that reflect both predictable trends and specific cost variations. Forecasting the balance sheet involves estimating future financial position using various methods. Most asset and liability items are projected using the percentage of sales method, except investments which are estimated based on specific data. Current liabilities and provisions are also projected proportionally to sales. Equity and preference capital balances are typically carried over from the previous year unless specific funding is planned. Long-term debt is computed by adjusting planned fresh funding and repayment of the existing loans. This approach provides a structured way to anticipate financial needs and ensures alignment with the projected business growth and operational requirements. Forecasting the balance sheet involves estimating reserves and surplus by adding retained earnings from the projected income statement to the previous year's balance. The total assets and liabilities are then compared. If the assets exceed liabilities, the difference indicates external funding requirements. Conversely, if liabilities exceed assets, the difference reflects surplus funds available. This process ensures the balance sheet aligns with the financial projections, helping businesses anticipate funding needs or excess resources. By addressing these discrepancies, organizations can plan financial strategies effectively to maintain a stable financial position and support future growth. In this topic, we have learned that financial forecasting is the overall process of predicting an organization's future financial performance by analyzing the historical data, market trends, and economic conditions. We have also learned the methods of forecasting income statement, a percentage of sales method, budgeted expenses method, and a combination of these two methods. We have also learned forecasting the balance sheet involves estimating reserves and surplus by adding retained earnings from the projected income statement to the previous year's balances. That's all for today. Thank you and happy learning.